Okay, picture this. A huge company pulling in millions every single month, but then suddenly, poof, bankrupt, gone.
Yeah. And then on the flip side, you see this quiet little startup and suddenly it's a billion-dollar unicorn. Seems completely counterintuitive.
It really does. And that paradox tells you something critical, doesn't it?
Yeah.
It's not just about the revenue or even the cool product.
Exactly. The difference maker is often the management, specifically how the money is handled.
Right. Welcome, everyone, to the Deep Dive. Today, we're cracking open, the engine room of successful businesses. We're talking about financial management. It's like the brain behind the brand. Because let's be honest, money itself doesn't just magically make a business grow. It's the smart money management that does it.
And that's our mission today, really. To unpack that strategy, think of financial management as the GPS for a company's money. It guides you towards profit efficiency.
And crucially, keeps you from driving off a cliff financially.
Precisely. It installs those guardrails.
So, okay, let's skip the dry textbook definition. What does it actually do? What questions is it trying to answer for a company?
Well, fundamentally, it boils down to three core questions. First, how do we get the money we need? Acquire it.
Okay, acquisition. Makes sense.
Second, once we have it, how do we allocate it? Where does it go to be most effective?
Allocation. Got it.
And third, how do we control and monitor all of that? Keep track, make sure we're hitting targets, staying on course.
Acquire, allocate, control.
Okay, that framework.
Yeah.
You can see it perfectly with Tesla, especially during that huge push for the Model 3 launch. That wasn't just about building cars.
Right, it was a massive financial operation, wasn't it?
Absolutely huge. They needed enormous investment. Think production lines, raw materials.
All people, hiring everyone.
Exactly, manpower.
Yeah.
So financial management was critical for, number one, raising those funds, often through, selling stock strategically.
Yeah.
Then allocating really strict budgets to different departments. And third, constantly watching the cash flow, making sure the assembly lines didn't just grind to a halt because they ran out of money that week.
So without that financial architecture, even a game-changing product like the Model 3 could have just bled the company dry.
Easily. The financial discipline held the whole vision together.
Okay, so that's the framework. Acquire, allocate, control. But what are the actual goals? Like, what's the point of all this? What battles are being fought in the CFO's office every day?
That's a great way to put it, battles, because the goals are often in tension. You can sum them up with 4 key words: profitability, liquidity, efficiency, and stability.
Okay, profitability. That one seems obvious. Make money.
Yes, but it's a bit deeper. The sources really emphasize shifting from just profit maximization this quarter to wealth maximization over the long haul, increasing the company's value for its owners, the shareholders.
Right, thinking long-term value, not just immediate profit.
Exactly. But here's the tension. The moment you chase profit, really aggressively say, you pour every spare cent into building a new factory for the future, you might suddenly run into a problem with liquidity.
Ah, the classic short-term versus long-term fight. We hear liquidity all the time. What does it actually mean for the person managing the money?
Liquidity just means having enough cash easily accessible, like right now, for the essential day-to-day stuff, paying suppliers, making payroll next Friday.
So you could be showing a massive profit on paper, but if all that cash is tied up waiting for customers to pay you, or it's sunk into equipment, you could actually be in trouble.
Big trouble. You can't pay your bills. So profit is great, obviously essential, but it can't kill your ability to survive week to week.
Infosys comes up here as a company that managed this tension really well. They're known for keeping high levels of cash, being pretty conservative with reinvestment.
That's right. And our sources suggest that exact discipline is why they could sail through major global market downturns, when others were struggling, and actually come out stronger.
It takes discipline.
It really does. Narayana Murthy had that quote, "Progress is often equal to the difference between mind and mindset." In finance, that mindset is about rigorous financial discipline, avoiding waste, not overspending. It's about proper utilization of funds, making every dollar count.
Okay, so that strategic approach, that discipline, it leads directly into the actual decisions being made, doesn't it? It's not just one big task. It's like a continuous cycle of choices.
Exactly. It's like a 360-degree view broken down into 4 main types of strategic decisions every company wrestles with.
Right. Let's break those down. What's the first one?
First up are investment decisions. This is often called capital budgeting. It's basically deciding where to put the company's money to get the best possible return down the line.
So for a company like Apple, it's constantly weighing up, like, should we pour billions into R&D for some, potentially revolutionary but risky new product?
Right.
Or do we play it safer and invest that money in opening more retail stores around the world, which probably gives steadier, more predictable returns?
Precisely. That involves careful capital allocation and constantly weighing that risk-return trade-off we talked about.
Okay, investment decisions. What's next?
Number 2, financing decisions. So you've decided where to invest. Now, how do you get the money to do it?
The acquire part again.
Exactly.
Yep.
This is where you choose your funding mix. Do you borrow money, which is debt? Do you sell ownership stakes, which is equity? Or do you use some kind of, hybrid combination?
The Reliance Geo example was interesting here. They needed massive funds, but instead of just taking on huge loans,
They sold stakes, equity to partners like Google and Facebook.
which allowed them to grow like crazy without being crushed by debt payments. That's pretty smart financing.
Very smart. And this ties into not just liquidity paying short-term bills, but also solvency. Solvency is about being able to meet your long-term debt obligations. Good financing strategy looks after both.
Okay, so investment financing. What's the third decision type?
Third is dividend decisions. Once the company makes a profit, what do you do with it? How much do you give back to the shareholders as dividends right now?
Versus how much do you keep and reinvest back into the business, hoping for even bigger profits later?
Exactly. It's a direct line to managing shareholder expectations and building trust. Companies like TCS, for instance, are known for very consistent dividend policies.
Why is that consistency so important?
It signals stability, reliability. Investors like predictability. It helps build that long-term shareholder value, not just through the dividend checks themselves, but by boosting confidence, which hopefully leads to capital gains as the share price rises over time.
Makes sense. Investment financing, dividends. What's the fourth?
The fourth loops right back to where we started, really. Liquidity decisions. This is the day-to-day management of cash flow, making absolutely sure there's enough cash, grease the wheels,
Keep the engine running.
keep the engine running. The analysis we looked at put it bluntly. A business without enough liquidity is like a car without fuel. Doesn't matter how great the engine is, it's not going anywhere.
Yeah, okay. And the Zomato IPO example really pulls all these threads together, doesn't it? Going public forced them to nail everything.
Oh, absolutely. To pull off an IPO, their financial management team had to be firing on all cylinders,
Right.
preparing incredibly detailed financial reports.
Total transparency required.
Complete transparency, meeting every single regulatory standard. They had to convince investors they had a solid plan for investment, smart financing, and a path to long-term profitability and stability. It's a massive financial undertaking.
Okay, so those are the big strategic decisions.
Yeah.
Now let's shift gears slightly. What are the core functions happening inside the finance department day to day?
Right, moving from strategy to operations. Generally, you can group the core functions under 3 main activities that are always running side by side. Planning, control, and the decision-making we just covered.
So financial planning comes first, laying the groundwork.
Yeah, that's where the vision takes shape financially. Forecasting what the company will need, estimating how much capital that requires, figuring out the best mix of debt and equity, the capital structure. You see this clearly when a startup builds like detailed 3-year, 5-year financial projections just to get that first round of seed funding.
Okay, planning sets the course, then financial controls about staying on that course.
Precisely. This is the monitoring part. Budgeting is key here. Setting budgets, tracking actual spending against those budgets, analyzing variances. Maruti Suzuki, for example, is mentioned as using really detailed budgeting and tight cost controls as a core part of how they maintain their market lead. They stick to the plan.
Got it. Plan, then control against the plan. And the third function.
The third is simply the ongoing execution of financial decision-making, applying those investment, financing, and dividend choices continuously as opportunities and challenges arise. It's not a one-time thing.
And who's steering the ship? The financial manager, the CFO?
Yeah, the chief financial officer, the CFO, is typically the captain, the main strategist here. Their job involves ensuring there's always enough capital, managing those funds wisely once acquired, keeping a close eye on cash flow.
And a big one must be minimizing the cost of capital, right? Making sure borrowing money or selling equity isn't unnecessarily expensive.
Absolutely critical. Minimizing the cost of capital is huge. Plus, ensuring compliance with all the financial regulations. We saw Ruth Porat mention, Google's CFO. She's known for exactly that. Driving cost discipline while also finding innovative financial approaches.
And what tools are they using? It can't just be spreadsheets anymore, surely.
Oh, definitely not just spreadsheets, though they're still used. Key tools include things like financial ratios, return on investment, debt to equity ratio to quickly assess health. But the cash flow statement is absolutely fundamental.
Why is that one so crucial, more than the income statement?
Because the income statement shows profit, which might include revenue you haven't actually received yet, the cash flow statement shows the actual cash coming in and going out. It's the reality check on liquidity.
Okay, the real money movement.
Exactly. And then you have sophisticated software, things like Zoho Books or QuickBooks for smaller operations, but larger companies rely heavily on ERP systems, enterprise resource planning like SAP or Oracle, which integrates finance with everything else. And advanced financial modeling software is key.
Like the Amazon example, using modeling to optimize basically their entire business based on financial data.
Yeah, optimizing logistics routes, dynamic pricing, negotiating better supplier contracts, all driven by sophisticated financial models that predict the impact of decisions. It makes finance incredibly actionable.
Okay, so we have the actions, the tools. What about the underlying rules? The foundational principles that make this whole system work reliably.
Right, the bedrock principles. We pulled out 5 that seem non-negotiable for sound financial management. First, probably the most famous one, the risk-return trade-off.
Higher potential return usually means taking on higher risk.
Always. There's no free lunch. The key is finding the right balance for the company's goals and risk appetite.
Okay, risk return, principle number 2.
The time value of money. Simply put, $1 today is worth more than $1 promised a year from now.
Because you could invest today's dollar and earn interest, right?
Exactly. Or because inflation might erode the value of the future dollar. Strategically, this principle is used constantly in finance to calculate the net present value of future cash flows, helping decide if a long-term investment is actually worth making today.
Makes sense. Number 3.
Number 3 revisits that tension we discussed, profitability versus liquidity. You need both, but you have to manage the balance. Pursuing profit aggressively can't compromise your ability to pay this month's bills.
Okay. Principle 4.
This one's crucial for managing debt and assets, the principle of matching. Basically, match the lifespan of your funding source to the lifespan of what you're funding.
Meaning, like, don't take out a short-term loan to build a factory that will last 30 years.
Precisely. Use long-term financing, like long-term debt or equity, for long-term assets, like buildings or major equipment. And use short-term financing, like lines of credit, for short-term needs, like temporary inventory buildup. Mismatching can cause serious cash flow problems.
Got it. Match the timing. And the last principle.
Number 5 is diversification. Don't put all your financial eggs in one basket. This applies to investments the company makes, sources of funding, even customer concentration sometimes.
Like the Apple example, having a diversified investment portfolio to cushion against market shocks.
Exactly. Diversification provides stability and reduces overall risk.
Okay, these principles make a lot of sense for big corporations. But it feels like they should apply to personal finances too, shouldn't they?
Oh, absolutely. The connection is direct. Think of managing your personal finances as being your own CFO. You're applying the same ideas. Well, budgeting your salary, that's financial planning and control. Deciding whether to take a loan for a car or save up, that's a financing decision. Creating an emergency fund, that's managing liquidity. Planning investments like, mutual funds, retirement accounts, that's investment decisions. Weighing risk and return, considering the time value of money.
So if someone earns, say, $50,000 a month, the process is similar. Budgeting, saving, investing.
Pretty much. Figure out your inflows and outflows. Maybe aim for a target, like the classic 50-30-20 rule, 50% needs, 30% wants, 20% savings and investment. Track it. Adjust it. There are plenty of apps now, like Money Control or ET Money, that help with exactly this kind of personal financial management. Avoiding impulse buys on credit cards, that's financial discipline.
Right. But even with good planning, for companies and individuals, things can go wrong, right? There's still big challenges.
Definitely. Markets fluctuate wildly sometimes. Inflation makes the cost of capital go up. Currency exchange rates can hurt international businesses. Regulations change. And unfortunately, there's always the risk of fraud.
And the cost of getting the strategy wrong can be devastating. The pandemic really highlighted that.
It really did. We saw large established airlines like Air India and Jet Airways, which were already carrying a lot of debt. They just couldn't cope when revenue dried up.
Why them specific?
Reports pointed to poor cash flow management and unsustainable debt levels before the crisis hit. They maybe prioritized expansion chasing market share, perhaps without building enough of a financial cushion, enough liquidity, enough discipline to handle a major shock. It underscores how vital robust financial strategy is, especially managing liquidity and solvency.
Looking ahead, finance isn't static either. What are the big trends changing the game?
It's evolving fast. AI and machine learning are getting huge for more accurate forecasting and risk analysis. Blockchain is being explored for more secure and transparent transactions.
ESG investing seems massive now, too.
Huge. Environmental, social, and governance factors are increasingly driving investment decisions, not just pure financial return. We're also seeing crowdfunding changing how some businesses get started, and real-time data dashboards becoming a standard.
Like that Nika example using data analytics right now to predict demand for festivals.
Yeah, that allows them to scale up production and inventory just enough to meet the demand, but not so much that they're stuck with unsold goods afterwards. That's real-time financial control powered by tech, minimizing waste and maximizing profit efficiency.
And it's worth remembering, I guess, that the focus of financial management changes depending on the industry.
Absolutely. A manufacturing company might obsess over unit production costs and supply chain efficiency. A bank's finance team lives and breathes liquidity management and assessing credit risk.
Whereas an IT company is probably focused heavily on funding R&D and managing global operations across different currencies.
Exactly. Or a service business might focus intensely on managing personnel costs and billing cycles. The principles are the same, but the emphasis shifts based on the business model.
So wrapping this up, financial management really is about control, isn't it? But also vision and execution, from figuring out how to get the money to deciding the strategy, managing the risks. It's what makes sure a business doesn't just survive, but actually thrives.
Well said. It provides that framework for discipline and strategic thinking. Like Peter Drucker famously said, what gets measured gets managed. Finance is the ultimate measurement and management system for a business's resources.
Okay, a final thought then. We touched on ESG, environmental, social, governance investing becoming more important.
Right.
And robust financial management traditionally focuses on maximizing shareholder wealth,
Yeah.
which is mostly about financial return. How does the CFO start balancing these potentially conflicting goals? How do you strategically manage for, say, environmental impact alongside profit maximization when those things might require different, maybe even opposing investment choices? That seems like the next big challenge.